Sorry for all the technical mishap, guys, but we are just trying to get Ryan's pretty face on there. You're not going to enjoy my face. His face is more good. It's better than mine. So, but anyway, you have to live with my face now. But for those who don't know who I'm Rahul Visal, co-founder of the Chicago REA. Andrew Holmes and we started the REA, and we have now over 6,000 members. Chicago REA is one of the largest REA in the area. Before COVID, for those who are new, before COVID, we used to have like meetings in 13 locations, different part of city, and a lot of fun, which is everyone is missing now. But during the COVID, we just want to keep people updated on all the information, what's happening during the COVID, what sort of information we are getting, and people like Ryan Smith, who are the main players in the Chicagoland area. We always want their perspective, what they are getting from their side, and we just want to compare the notes and get things rolling. So for those who are new, Chicago REA, welcome. We will, like I said, we will start doing our normal meetings once the governor allows us to do it. We are all ready to go for it, but obviously with the COVID situation, none of the hotels and none of the areas we can have more than 10, 15, 20 people. So that's coming. While we are doing that, I guess this is the way to communicate with you, and webinars are working well, and we'll try to keep it going every week from here on, and try to bring the guests like Ryan Smith, somebody who knows what's happening in the market, who knows what's going on. So Ryan, welcome.
Thank you. Thanks for having me. Thanks for everybody for logging in and joining today.
Okay, so why don't you go ahead and tell people a little bit about yourself, what you do, what exactly you have done.
Yeah, I'm a real estate broker by trade. I'm a licensed broker at Remax Properties out of Western Springs. Specialized in the default space, meaning I represent mortgage servicing companies, GSEs, investment pools, and anybody that's in the NPL space, the non-performing loan space. And we do about 400 to 500 transactions a year. And we see pretty much just about everything in regards to real estate and defaults in Chicago. So that's what I do. Yeah.
From the REO side of the thing, like what is, like, I guess you can explain what is REO first, because we have a lot of people on this call, and maybe you can go explain a little bit about what is REO, what makes it REO, and then what are the areas you work in.
Yeah, REO is an acronym for real estate owned. It refers to properties that are bought back by the servicing company or the bank which owns them, which held the paper. When somebody goes in default, the property then goes to the foreclosure sale. If it's not bought by one of the REO members or another like investor, the foreclosure sale reverts back to the bank who was holding the mortgage and put it up at the sheriff's sale. When it comes back to the sheriff's sale, we manage the property from the time we get in through the time we sell it. We oversee evictions, cash for keys, trash out, marketing, and just maintain the properties on behalf of our clients. And we handle the entire Chicagoland area. I go from Wisconsin-Illinois border up in Antioch, all the way down to Lansing, all the way west, Oswego, Sandwich, Elburn, Cookeville, DuPage, Lake, Kendall, and McHenry County are the counties that we handle. Our main office is in Western Springs, which is in Cook County, west suburbs of Chicago. We have a couple other satellite offices and a team that covers the entire Chicagoland area.
Yeah, so Ryan Smith is like with us for last, I think I know Ryan for more than 5-6 years now, or more actually. He's always part of our 3-day camps and boot camps, also mastery when we're doing training. So a lot of the mastery people have bought properties from him. And REO is, like he explained, after the sheriff's sale, if the property is not sold at the sheriff's sale, it goes back to bank, and then bank has to get rid of the property, and they basically dump it on Ryan, and then Ryan has to find a buyer for it for the bank, and maintain it and do all the property management while property is on the market. So, but that kind of opens up a very good opportunity for a lot of investors because bank is really not tied with the property. They want to get rid of the asset. Obviously, they're looking for a certain amount, and uh, but not everybody is ready for the property which sometimes might be in a needs a lot of rehab. Sometimes it is in very bad shape. So that's where the investors are really got into get a real deal. And we have bought a lot of properties. So Ryan, I guess going back to the COVID or before the COVID, I guess what was the market like when we went into March, like before everything kind of stopped?
The market was moving. There, it was moving. The values, I personally felt that the values have been overinflated in Chicago for the past 12 to 18 months. A lot of people would argue that. I think we had, people were paying higher price than they should have paid. But I mean, we were selling properties and people were buying properties. There were a lot of buyers in the market. There were a lot of financing options out there for buyers, such as hard money. And we've seen a lot of that kind of slow up. Hard money slowed up right around March. They pulled back a lot of hard money or made the guidelines a lot more stringent, as they did with FHA financing and jumbo conventional. When I say stringent, for example, an FHA, you used to be able to get an FHA with a 540 score, and I think they bumped that up to low 600, which limits a buyer pool, right? The jumbo loans, you used to be able to buy with 5% down and a 640 score. They increased that score and increased the down payment. So we've seen a lot of that. When COVID first hit, we saw a lot of uncertainty, and there's still uncertainty within the market, but a lot of people pulled out of deals. They just kind of put everything on pause. I consider us to be out of the COVID thing as of now. There's a lot of stuff going on in the market. Buyers are back out there. People are buying again, and the market's busy. Where's it going to go? Nobody knows. I have my predictions, but we're busy now. We're starting to see the residential side busy. We're starting to see multiple offers again on properties, and there's a small supply and still a large demand, even though with everything that's happened.
So going back to REO properties, like before COVID and after, maybe it's the financing wise, like are these properties people have to get financing, or it has to be a cash deal, or cash is a king in that case?
Yeah, I mean, at the end of the day, financing is still cash, right? Because it comes out to be cash, but the cash always helps. Waiving inspection will help. Cash is big, but yeah, I mean, cash helps. We're seeing a lot of 203K loans right now coming out. Hard money is not what it used to be. If I get a hard money on an offer today, if you're out there from Chicago REO or another investor and you have a hard money pre-approval, really make sure that you have your T's crossed and your I's dotted, because hard money is known for giving a pre-approval and not being aware of the rehab budget. And then when it goes to closing, they're going to ask the investor for more money down because the rehab budget isn't what the investor says. Every investor says, oh, I can rehab this house for $30,000, $50,000, when in reality, they don't take into consideration a lot of the ins and outs of a rehab. And that $50,000 bid that they told the hard money to get the pre-approval often jumps to 80, 90, 100,000, which will no longer qualify them for the loan. So, I mean, if you are going to use hard money, make sure that you discuss in depth, you have real bids, you have real numbers to avoid the fall through rates. And at my office, we're screening hard money buyers a lot more diligently. We're asking for rehab bids up front before we accept the offer, so we can see. A lot of times when you go for a hard money loan, you can only finance up to about $75,000 for a renovation. So if we can look at the renovation bids prior to accepting, we can put our seller in a better position to make a wise decision.
Hey, Ryan, this is Andrew. Sorry, I was.
Andrew.
Hey, man. Sorry, the Rahul was kind of getting the whole thing started. So we were talking about this. There's a company called Do Hard Money, and they're notorious for this kind of BS, where they'll promise you the world, and then 2 days before the closing, the whole thing kind of just falls apart. You want to talk about that? Explain how that works?
Yeah, and that's kind of what I was just touching on with Rahul. a lot of times they'll give you the pre-approval. They'll give everybody a pre-approval. They want you all to buy. They want to give you all the money. I mean, they're charging 6 points at 18%. Why wouldn't they want to give you the money? But they don't ask enough important questions up front. They're out of state. They have no idea of the local markets. And like I said previously, if the buyer, the investor, isn't fully aware of what needs to be done on the rehab, it's all fluff until you get to the closing when the real numbers come in. And hard money lenders, we're starting to see them a lot more conservative on the ARV values. So, the ARV value that you might feel $100,000 asset, 60,000 repairs worth 250. Once you get closer to closing, the hard money might come back and say, yeah, it's worth 200. They're going to be a lot more conservative coming because the future is unknown, right? Nobody really knows what's going to happen. But if you look at the stats, you kind of predict what's going to happen. But so we're seeing a lot of hard money guys do that. There's a couple that I trust and that I rely on, but besides for that, 90% of the hard money, I seriously question when I see it.
So let's talk about the market a little bit, because this is where kind of this whole call got prompted from initially, which was that a lot of people are saying, oh my God, the market's great. There's clearly a higher demand, not as much inventory on the market. I see it differently because everybody says, well, we're not in a depression. To me, 15-20% of the country is unemployed. Now they're getting the printing money and they're basically paying people because just politically, and you can't have economic collapse. But over time, that's going to have an impact on real estate. I mean, there's just no ifs, ands, or buts about it to me. What's your opinion? Because we were discussing this quite a bit the other day.
Yeah, we talked the other day. I talked to a lot of, I'd say, retail agents. I consider myself in the default space more than the real estate space. But, retail agents will tell you the market's going to bounce back once COVID's over. It has to. The supply doesn't match the demand. While they're somewhat right in hindsight, the supply isn't there. The demand questions me. You've got 30 million people unemployed. You've got FHA buyers where the FHA credit scores took a 30, 40 point FICO increase. You need bigger down payments. So while in theory, the supply and the demand thing, your demand's also less because you limit your buyer pool. I think that's going to affect the market. I mean, you don't have the buyers out there. The buyers with money, if you look at the higher price points, you look at Burr Ridge, for example, which is a upper class community value wise. They're right now over $800,000. There are 32 properties currently on the market east of County Line in Burr Ridge. There's been 3 sales over $800,000 in the past 6 months. Market times are about 330 days on average. So I mean, the people more well off are being a lot more cautious. So that demand isn't what it's thought to be, right? And then, your other buyers are losing their jobs, and we're in a shaky ground right now.
See, I think if basically properties are in the starter price range, they'll sell. But anything in the higher price range, or if people are trying to truly do a flip and they're not conservative, they're going to have a hell of a lot of problems.
Yeah, and I just talked to a good friend of mine who's very wise in the industry, and we agree the $100,000 to $300,000 price point shouldn't be hurt much, right? You're gonna see a big decline in the higher value stuff. You've already seen it decline by the stats I just said, and I think the middle of the market, 250 to 400,000 within the city of Chicago, is going to see a correction. I mean, you already saw it in Belmont Cragen. If you're familiar with that area, it's right off Belmont, Cicero, up in that northwest side area. A lot of brick bungalows, a lot of blue collar buyers using FHA financing. And today's FHA is no different than the 100% financing from 10 years ago, right? The only difference is they're calling it something different. They're calling it an FHA loan, but in reality, they're buying a property with 3% down, and the seller's paying the 3% closing costs. So they have no equity in their home. In Chicago, average across the nation, 9.1% of homeowners are underwater. You come to Chicago, you have 253,000 homes underwater at about a 15% rate, which means they're negative equity. They have no equity in their home. So you take the fact that they have no equity, the property taxes are rising, unemployment's a factor. It's hard for me to see how these people can still maintain affordability going forward. So I think you're going to see a big correction in those markets there. You already have. For example, last year we were seeing bungalows in Belmont, Craig, and sell for 350 to 390 renovated. Today it's about 275 to 305 renovated. So I mean, you've seen a drop in those neighborhoods now. I think the surrounding stuff will also drop. And then you move to the south and west sides of the city where you saw a huge rise in values in the multi-family space over the past year. I mean, we're selling stuff in Lawndale right now, which is just on the west side of the city. We're selling Greystone 2 units over there for 130 to 140,000 as is, pre-renovation. So if you take a 2 unit that's been worn and beat up and you put 40,000 per unit, 20,000 exterior, now you're in a building for $260,000, $280,000, and it just doesn't equate to true value. And one of the reasons that we saw that rise was hard money, right? Hard money overinflates a market because you have a lot of investors not very knowledgeable. They don't have a lot of their own capital, so they're willing to overpay, and they're buying off speculation, which happened when, Andrew? 2008. A lot of people were buying off speculation as well. So, we're seeing a lot of that stuff.
To me, man, this is a repeat of what we saw.
Just
At
on that
that
same
time. Sorry, go ahead.
Yeah, just on that same note, Ryan. So you talked about a lot in Chicago. Have you seen that same impact on the suburb side? Because most of the people who are part of Chicago REO or Mastery, or we tend to invest in the B suburbs. Like when I say B type of areas where something like very stable neighborhoods, and that's the price range we just talked about, 100 to 300,000. Are those ARVs are holding up, or is looking at the unemployment of 20%, looking at the taxes going higher? There are all the indications that the market is kind of slowing down, and it will be slowing down later after the COVID, because a lot of the programs are in place right now. People are getting a lot of help, and people who are brink of bankruptcy or brink of losing the house, they are getting a lot of help from the Fed or from the loan program. So maybe like after 3 months or 6 months from now, that's where the main impact is going to come, which, like you said, it's very uncertain. But in suburbs, in the solid suburbs, solid neighborhoods, which we call as B or B plus, have you seen a lot of activity now starting up, or it's still kind of people are uncertain and on hold?
I've seen, from a suburb standpoint, I've seen suburbs, the 290 suburbs, I'll call them, right? Cicero, Berwyn, Bellwood, Maywood, Oak Park. I've seen those. Berwyn especially is getting killed right now on the ARVs because of the property tax. They were just reassessed there, and the taxes just came out recently. And they saw a huge jump, and I'm trying to move stuff in Berwyn now for 140, 150 that guys won't touch because the ARV is not there. I mean, the values have softened in Berwyn. We're seeing longer market times there. Cicero as well. You get farther out west to your Schomburgs and Streamwood, Hoffman Estates, stuff like that. Values are pretty stable right now. I haven't seen much of a decline out that way. Your south suburbs are, Lansing, Sauk Village. They're lower prices. So like if the market, if you're starting to see a decline in market, they won't be hit as hard because, they're $50,000 to $80,000 properties as is anyways. What's killing those south suburbs are the property tax. I mean, we see properties in Park Forest with an as-is value of 40 to 60,000 and anywhere from $7,000 to $10,000 in taxes. Country Club Hills, $16,000 to $20,000 in taxes. I mean, that's going to catch up, and it's going to bring the values down because it affects affordability. If you got a guy that's pre-approved for $300,000, his taxes are $1,000 a month. I mean, he's got to be pre-approved for $400,000 to buy a $300,000 house. So, I mean, you have to take that stuff into consideration when you're in REO or you're an investor looking to flip something. You have to take the taxes into consideration. And real estate's always going to sell if it's priced right, and you'll always do okay. And what Andrew and I were talking about the other day is if you are looking and you have a mindset of flipping, buy projects that you can pivot out of. And when I say pivot, you can buy it, renovate it, put it on the market for 45 days. If you don't get a bite or you don't get an offer, be prepared to flip it to a rental and still maintain, cash flow, and you're not going to lose on the property.
So Ryan, explain that point because a lot of people will miss that because that's a key point that you just went over. A lot of people are still. I just got a call yesterday from somebody buys the property for 200, is going to put 100 into it. He's like, Andrew, all day long 550, man. I'm like, dude, you're nuts. I truly think you're nuts. Why take that chance right now? So explain that point, what you're saying in terms of by using a price range.
You talk about the pivot into a rental, or?
Correct, correct. Like, what do you exactly mean by that? Because a lot of people are over exuberant, and rentals will work all day long with the right tax numbers, but not all not all flips are going to work. That's where the uncertainty is.
Yeah, the uncertainty. I mean, like I said a little bit ago, you look at the higher end markets, and over $1 million in some of these communities that have traditionally been, 800 $1 million to markets. You're seeing the market times rise. So take Burr Ridge. Say you got a guy who looks at a house that was, it was built in 2002, and they had a $1.6 million mortgage on it, and he can buy the house for 800 grand. He's speculating that he's still going to be able to get 1.6 out of it, or 1.3, right? Oh, I can put 200 in, I'll make 300 grand. Well, you're not going to be able to rent that $8,000 square foot home in Burr Ridge where you can get cash flow to cover what you put into it, right? So something like that, you should never flip off speculation, and you got to look at the market data. I mean, you see what's happening in Burr Ridge right now. There's 26 homes over $1 million with 2 sales. I mean, so you have to be cognizant of that. I mean, if you get down to lower price points, 100,000 to 300,000, you should be able to buy those with hopes of flipping. And if not, you can collect $1,400, $1,500, $1,800 a month rent and still carry your way through and ride the storm. You don't want to overextend on a flip, or you never want to look at the market and say, oh, I saw this one house sell for 350, so I'm going to do that. Those are one-off houses. When I look at repair numbers for my clients, and we're thinking about repairing a house, and the top of the market may be 350, but a majority of it's at 280. I'm going to look at the ARV number at 270, right? I always look at it more conservatively. And if you get 280, 300, great. But if you can't get anything, can you rent it? And you've always got to, I think, run that scenario through your mind.
So what do you see coming in terms of, like, with your clients, all the banks that you work with? I mean, you're supposed to be the number one guy, man, in Illinois for REOs. If somebody came to you and says, man, are more REOs coming? What is your answer and when?
Are they coming? I would like to hope so. If I look at the data, I would say, I mean, the numbers don't lie, right? You've got over 3.6 million homes nationwide past due on the mortgage. In March, you had 0.3%, delinquency rate on FHA loan, or 3%, I'm sorry, 3% delinquency rate on FHA. Now you're up to, 5.25, they've seen a jump in. The conventional loans were at 0.25%. Now they're at about 2.8%. So, I mean, you're seeing people default. You have 3.6 million homes past due on their mortgage. The rates of default are rising. You have unemployment, property taxes. And in Chicago, we're the number one market in the country that's underwater on their mortgages. I mean, only like 18% of homeowners have more than 20% equity in their house. So, when I see the numbers tell me, people are in trouble. And then you're going to have people tell me, well, there's forbearance, right? People are filing mortgage forbearance. They're going to be okay. A forbearance, people have to understand what a forbearance is. A forbearance is not a loan modification. They don't reevaluate the loan and put your payments on the back side of the mortgage. That would be a loan mod. A forbearance is a forgiveness for 3 months. And come on month 4, you're going to have 4 months payments due to the servicer. If you're not going to be able to, if one of the people in the household got laid off, they don't have a job, and they apply for a loan mod, it's going to get denied and it's going to go into default. The amount of forbearance filings are up drastically, like 200 something percent. So, I think you're going to see a larger rise of defaults, but I don't think you're going to see it for 12 to 18 months, especially within Illinois and Cook County, because of how slow our court systems are and how slow the process is. And then I always hear the argument, well, the government's got to step in and do something. Yes, for Fannie and Freddie backed loans, which is 70% of the mortgage market. There's another 30% of the mortgage market, which is privately backed mortgages. And Freddie and Fannie cannot regulate over privately backed mortgages. So, that 30% of the mortgages will still dictate the market, but that's what I see.
What are you
Ryan,
hearing from your banks? I mean, what is their take on it when you're pricing properties to put to market right now?
We're not pricing like we were in 2008, 9, and 10. I mean, back then, we would take, the three lowest sold, three lowest active, and then drop it lower than that, and we'd move it, right? I mean, but there was more of a mill back then. Right now, the market's kind of stable. I mean, we're not seeing much, except for in certain pockets, like Berwyn, we're seeing it, Belmont Cragen, the higher end market, we're seeing a decline. But overall, from 200 to 500,000, it's stable. Things are moving. So we're not, when we're pricing stuff now, I'm not taking much of the future into consideration. When my clients ask me, hey, it looks like some room on this, should we rehab it? I'm hesitant on that because I don't know what's going to happen in 6 months, right? I don't know where the market's going to turn, and I will see. I feel that a default's going to come. It just depends on when the. Sorry, you there, Andrew? You there?
Yeah, I'm here. We lost you there
Andrew,
for a second.
yeah, sorry about that. A correction is going to come. When is the correction going to come? Probably you're going to start seeing it towards the latter part of this year. And I'm starting to be reminiscent of the early 2000s right now, because if you look at the market, if you know a real estate agent that's out there, their phone's ringing off the hook. Everybody's putting their house for sale. Pre-08, everybody's putting their house for sale. The market was quote unquote on fire, right? So I'm seeing some of that, and it kind of reminds me of that, where everybody's so busy, everybody's moving. And I think that a lot of people are putting their house on the market because they're concerned. They don't know what's going to happen, and none of us really do. I mean, but I don't think for the short term, I don't think you're going to see much of a correction. I think 12 to 18 months from now, you're going to, I don't know, 6 to 10% correction maybe. But that's my take on it.
Rahul, go ahead. You were asking something.
yeah, I just wanted to add on that forbearance thing. Like most of the mortgages, which a lot of the investors which I'm talking with, and a lot of people who are asking questions about forbearance, and you're right, forbearance is not something which you have to pay at the end of the forbearance period. So after 3 months or something, you have to come up with that money, and if you don't have a job that time, you are going to be in trouble. They might extend it by a few months. They might go for another 3 months. So if your forbearance started in April, which is April, May, June, and now June they'll call you back, the mortgage people, and they're going to ask you, are you still in trouble? Then they can extend for 3 more months. After those 3 more months, they will be asking you, like Ryan said, is a loan modification, but then you have to qualify for it. So at this stage, I don't know how many people are going to qualify, especially with what COVID has done, that a lot of the industries are kind of wiped out. Travel industry or even the hotel or restaurant industry. So who knows who has the job that time? And I think the impact of COVID regarding the foreclosure or the properties underwater are going to extend into next year. But next year it will be a hit, and that's my opinion. But things are uncertain for a while, and they're going to be uncertain for more time. But Ryan, from your end, I guess the activity has started because you mentioned there are multiple offers on some of the properties. Which are these properties? Are these the same, the 100, 300, or those are the properties which are on sale?
Yeah, I'm seeing more multiple offers on owner occupant buyer type of stuff because there's not a lot of inventory right now that's clean, ready to move in. So we're seeing multiple offers on a lot of that stuff. The investor stuff, it moves quick if it's priced right. I mean, there's still investors buying, but the guys I see buying are are the smart investors, right? They're not overpaying, they're not over leveraging, they're being patient. They're not in a rush to jump into the market, and I think that's the mindset you have to have, and you have to be able to be willing to pivot and take your time. Patience is key right now. But there are deals. I mean, there's deals out there. You shouldn't step back all the way. Just be more aware of what you're buying.
See, to me, it's going to be a 18 month to 2 year, like you said, because of these, how it works in Cook County and a lot of these counties. But it's going to, at some point, and we may not see all of them come at once. It may be a prolonged pain, but to me, 100%, it's going to create pain, and people need to be conservative today. But I think it will bring down prices at some point. Certainly, we cannot see the appreciation that we've been seeing.
Yeah, I mean, Andrew, I was talking before you jumped on the call. I was talking about, in my opinion, I think the Chicago market over the past 12 to 18 months has been overinflated. I think people are overpaying for money because money was overpaying for homes because money was so easy to get. Hard money they were giving hard money to everybody. And hard money, while it's a great product when used properly, at the same time, it brings a lot of novice people into the market who are willing to pay top dollar for a property when they really shouldn't pay that much because they're buying on speculation, right? Well, I can do this, I can refinance out, I can rent the units out, and we're definitely going to see a correction. There's too many homes underwater. The property taxes are ridiculous, and the correction will come. It's just a matter of 12 months, 18 months, or 24 months. You there?
That makes perfect sense. So at this point, what are you seeing a lot of, have any numbers changed in terms of the number of properties you're seeing? Did your inventory stop, like the pipeline that you had, or has that continued throughout COVID?
No, we haven't got. I mean, we've had some files trickle in, but you got to remember, I don't see any files until it goes to the sheriff's sale, right? So the sheriff's sales stopped early mid-March, March 17th, March 20th timeframe. And since then, new files coming in have been at a standstill. The Cook County is supposed to open July 6th with the auction, and it'll be interesting to see how things play out. Freddie and Fannie have extended their moratorium until August 31st. So I don't know if a lot of the mortgage servicing industry is going to say, well, let's sit back and follow Fannie and Freddie, or if they're going to say push them out to sale right away. I don't know, and nobody really knows because it's back and forth every day. So I don't know when it's going to start coming out, but it'll be interesting to see when the courts happen. Another bigger thing is, a lot of your guys in REO are landlords. I want to throw this out there for you. In Cook County alone, there's 185 evictions filed every day pre-COVID. I talked to a lot of people at the Cook County courts, talked to a lot of the attorneys. They're expecting over 450 to 500 filings post-COVID per day. So you got to remember, the eviction timelines are going to be longer. The sheriff's sale timelines the backlog is going to be hard to work through, and that's the unfortunate part. But you just got to be patient.
I guess that number is very alarming. You said 185 pre-COVID.
Pre-COVID, there were 108. There were 185 on average. There were 185 evictions filed. Filed on an average day pre-COVID. Mm-hmm. Due to the backlog in so many situations, once they open it back up, a couple of the attorneys that I talk to, they're down there every day. They're doing eviction filings, and some other people. The average they're predicting is 450 to 500 files a day filed with eviction. Now, if you know anything about evictions in Cook County, the sheriff's office is already understaffed. The courts were already slow pre-COVID at 185 files a day. You double that count and put it on the county and the sheriffs, your timelines are going to be even longer. Somebody could stay in a home for up to 18 months easily in Cook County, easily. Pre-COVID, now I'm expecting, 2 to 3 years. So you got to be a little more, forward thinking, offer higher cash for keys, try to get them out in other ways besides waiting for the county. If you're a landlord or you're sitting, behind on rents.
Yeah, that totally makes sense. Means, well, basically not leverage your property too hard to the numbers which we used to get. And I was, and you're absolutely right, Ryan. Just before the COVID, the things were becoming so easy to get mortgage. Uh, the number of questions they used to ask on the underwriting was uh, were like very few questions, and anybody who is has the very lower credit and some problems, they still used to get loans, and they were very flexible terms, especially with the hedge funds. And those are the loans I think are they're over leveraged quite a bit at this stage. So if they go into the eviction, and if eviction is going to take longer for like more than 4 or 5, 6 months, those investors are going to get in big trouble. So is that an opportunity? Yes. So for somebody who can leverage their money and make sure the numbers are correct, they are the guys who can pick up those properties going forward. Obviously, we just don't know with when this whole thing is going to start, but there are all the indications that things are not as good as they seem from outside. So I don't know whether Andrew's still there or not, but
Yeah, I'm here.
oh no, you're here, and I think we lost Andrew.
I'm
Um,
here, man. It's really loud. That's why I'm not talking.
oh, okay, that's fine. Um, so in your from your side of it, I guess somebody uh, who is a good investor has some money and they're just trying to capitalize on this thing. What they should be doing? What do you think they should be doing from your perspective?
Be patient. Don't be patient. Don't let the money burn a hole in your pocket. Don't jump at a property and speculate. Oh man, it's sold for this. I can get this. Be patient. Buy right. Stay low. Like I got a good buddy of mine. He owns a ton of properties on the south side. He owns about 130, 140 doors, and he really doesn't get into a free rehab property for more than 100 grand, and then he rehabs it, puts renters in there, right? That's a smart investor, because say the world fell apart tomorrow and values dropped by 20%, he's only lost $20,000 value on that property, right? Where a guy that's buying, he wants to be the big guy on the block. Oh, I own this beautiful building up in Lincoln Park, paid $1 million for it. Well, you just lost 200. So I mean, limit your risk. Buy smart, cash flow heavy. If you want to try to flip it, that's fine. Test the market. There's not a lot of inventory out there. There's buyers out there. But if you be prepared to rent it, if you don't sell it in 30 to 45 days, don't chase the market. Don't buy on speculating the future, and just stick to the basics of buying and rehabbing and renting. I mean, don't try to overthink it. It's not a hard concept to figure out. The numbers have to match, and keep your initial investment low to if the market did crash, or if the values did correct by 8 to 10%, you're not going to be so hurt that you got to walk away from it. And that's probably what I would tell somebody if they were looking to buy.
Yeah, and especially with the Chicago market now, we are already in the month of June, or I would say month of July. If you're starting a project on a flip, and you're in the market in 3 or 4 months from now the winter is going to come, and if the property is not priced right, if it's not in the right location, it's going to be hard sell for a flip. So you have to be very cautious about those things on top of the COVID problems and COVID issues. But uh, I totally agree with that. Like what we are doing on our side is actually trying to keep the capital and only working on the deals which make sense. All the formulas which we go through, this is the time now to follow those. And anybody who can get into those numbers, that's where the investment should be done. Otherwise, what happens is if you push yourself because you haven't bought something in last month or so, and now there's COVID going on, and if the investor starts feeling like, okay, I'm missing the chance of buying great opportunity, great property, and if you push yourself that, and then you definitely going to make a mistake. So uh, patience is the key, and trying to find the right location and the right property at right number, which is not going to be over leveraged for you. That should be the key, and that's what we are doing on our side too. Uh,
Ryan, and the other thing with what Rahul is saying and all this we're talking about. So before we went into all of this, we had about 39,000 properties that were pre-foreclosure, right? If you looked at the numbers, to me, that number goes to 60. It may take a year, it may take a year and a half to go there, but it's going to go there. There's no
Yeah.
question. Now, if you take a Florida market, Texas market, that's going to get cleaned up a lot quicker. Our pain is going to be a lot longer, but it's going to come at a delayed time.
I agree with you. I mean, I read a lot of forums and a lot of articles on the default side in the servicing space. And, early on in COVID, there were a lot of articles that were saying, based on the forbearance and the filings we're having and the amount of people that are underwater on their property, behind on their mortgages, people were speculating anywhere from a 14 to as high as 30% default rate. Now, I think anything over 20 is astronomical and, unrealistic. But if you look at 2008, 2009, when we had the quote unquote crash, your default rate was about a 9.25, 9.5% default rate.
Mm-hmm.
If you take it on the lower end of what people are predicting, you say, all right, be very conservative, go with a 12% default rate. Even at 11% default rate, I mean, any double-digit default rate is going to really impact the market. We don't know what's going to happen, but the people within this defaults industry are predicting that the higher rates. So an 11% default rate is going to affect the market, unfortunately. I mean, it's going to. And then Chicago's a market unlike anywhere else in the country because of our property taxes. I mean, we've got a $200 billion pension deficit that they only try to fix by raising property tax every year. We got a house in Park Forest at $40,000 with an $8,000 tax bill. It doesn't correlate. It doesn't make sense, right? So you're going to keep putting the burden of high taxes on families of four making 100, 150 grand a year. It's hard for them to keep up with those taxes, and they're going to want out of their house. So when the retail people are trying to get out, and you have defaults going at the same time, when you have an oversupply of inventory, the only way to counter that is, be more aggressive on your pricing. So there's a lot of layers that could create a perfect storm. Could, if they all hit at the same time. So
It makes sense. I mean, we just wanted to have you on because you see a perspective from the default side of it. To me, you're not you're not a retail agent, and a lot of time retail agents, especially nowadays in the last 6-7 years, it's all about being a cheerleader. Oh, market's great, everything is going to be great. And I think for us as investors, we can't put our head in the sand, and we have to be kind of react to it before things start going wrong. I mean, that's the whole reason for having someone like you on, because you'll start seeing that kind of activity. But I think we're not fully open, and I think still people can buy time, and that's what's happening. So the real effects of it are going to come after the storm, passes. So
yeah, and like I said, we're not going to see, nothing's going to be seen in Cook County at least 12 months, probably 18 months. I mean, but it's coming. I mean, something's going to come. Even if it's a conservatively 5% decline in values with 7-8% default rate, I mean that's still going to be a bump in the market that you have to be aware of. And you have to be cognizant.
Right. So. No, and especially the suburbs which have crazy taxes. I mean, you take Forest Park, you take not Forest Park, Park Forest. You take Park Forest. You take Dalton. You take some of these suburbs.
Country Club Hills.
Country Club Hills. I mean, it's going to get destroyed. I mean, because at what point how far do the homeowners and the landlords keep paying for these taxes? It doesn't make sense.
And the only way to counter high property tax when you're selling is you have to make the price affordable to offset those taxes, right? We had a property in Country Club Hills. It was built 2006, 3,200 square feet, taxed at $17,000. We had to sell the house for $220,000 because your buyers got $1,200 a month going towards taxes, right? So, I mean, that's something.
Especially in those suburbs or those cities, you cannot justify higher rents too, because if you just go 2 or 3 blocks over, it's a better area with less rent. So if you want to just charge a lot of rent to offset that property tax, that doesn't work either. So those cities are going to get in real trouble, especially the investors in there. because people are not going to afford those property taxes or rents like 2,000 or 2,200 rents, which a lot of people got in Country Club Hills and other places. But I don't think that's going to continue further.
That makes sense. So, Ryan, we're going to have you, Rahul, any other last question?
No, I was just going through the question here. Is there anything like from the governor's law passed on the evictions? I guess Ryan already kind of talked about it. It's going to be means that's another different conversation. It will be but again, it's going to be another problem for landlords and for investors. If they are in trouble, then that's going to create more inventory or more issues, and then people are going to go underwater on the properties. In general, I guess the only 2 or 3 times the question was like we covered that little bit, but ARVs, like if you get into something right now, rental, the market is pretty stable in the last 2-3 months. At least that's what I have seen. But Ryan, what you have seen about the appraisals, are those coming okay for the deals you're closing right now, or?
Yeah, I mean, we haven't seen much of a decline yet. I mean, the values, except for certain neighborhoods like Berwyn got hit. Cicero's getting hit. Belmont Cragen, Norwood Park. Those certain pockets we're seeing it get hurt. But overall, as a whole in the Chicagoland area, the values haven't dropped much between 200 and 500,000. You get to the higher end stuff, and you're seeing a huge hit. But in certain segments, you're seeing it hit between 200 and 500. But overall, it's remained pretty stable. Appraisals are still coming in. We're not seeing a lot of time. We're not seeing appraisals come back at an adjustment. We have to adjust the price to close. So I mean, right now values are stable, and that's due to the lack of inventory. But the demand, I think, is going to wither down even further while the inventory rises as we get further away from COVID. So.
And if you're not adjusting the appraisals right now or the prices for the appraisals, those are going to create more comps for next 2 or 3 months. So,
Ro, what I am seeing a lot of, and while some investors love it, I think it's a huge red flag, is desktop drive-by appraisals. We're seeing a lot of drive-by appraisals, which are scary because, I mean, they're putting values on it. They don't know what they're looking at. They're just taking a bungalow, and the buyer could say, hey, it's in good shape, changes that. The listing agent could put creative MLS comments in there where the appraiser thinks it is and gives it a higher value, and that's another overinflated value. If you get enough of those desktop appraisals, you get really an overinflated market, which it seems good short term if you're an investor looking for a flip, but in the big picture of things, those desktop appraisals really will hurt you down the line. And that's something to see how long they're going to keep doing desktop appraisals for.
Yeah, makes sense. Those are the main questions, Andrew, if you want to wrap up.
So, Ryan, I know you like Naples, right? We've been going back and forth to Tampa. What do you see the difference between the Florida market, or do you have friends in that market that are in the REO business, or some other markets that's different? You pointed a couple of these things out about Chicago, because to me, Chicago is one of the tougher markets to do business in, but it's more lucrative. But you're always climbing an uphill battle. What is your take on the whole thing?
Andrew, I'll be honest with you. When I go to Florida, I don't really look at real estate. I don't, when I do get down, I'm going down there on the 1st actually for the 4th, but when I get down there, I try to get away from, that's my little peace of mind for a couple of days. So I don't really know what's happening in Florida. I've talked to a couple of people in Naples and what the market is. And within Naples, I mean, the market doesn't really get affected much because people down there that buy houses, they have money. They're smart, right? So, and they can weather storms. Outside, I haven't talked to anybody in Miami. I haven't talked to anybody in Tampa or Orlando. Texas, I haven't really asked about. I mean, my niche and what I'm good at is, these 6 counties up here, this little city of Chicago. So I haven't really focused on other. I can't answer. I don't know, to be honest with you. I'm not sure.
Okay. No, because the reason I asked that is that in Florida, for sure, Miami got hit. A lot of those condos and all that kind of stuff, big time.
Yeah.
I have some friends down there that are brokers right now, South Beach, and they're saying the exact same thing, that the basic stuff is selling, but all the higher end stuff is getting stuck. Now, a lot of their issue over there is because the money is coming from all over the world, and that stopped.
Yeah.
And so I was just curious if you've kind of kept an eye on what's going on around the country. So
Yeah. No, when I get down to Florida, I try to distance myself as much as I can, just regroup and get back up here. But yeah, I'm not.
got it.
Yeah, I'm not sure.
Okay, well, at least we definitely wanted to have you on. We'll probably, as this situation continues to change and as the market continues to kind of tweak itself, we'll definitely have you on again. It's always fun to talk about it. So from my end, it's a wrap. Anything else, Rahul?
No, thanks Ryan for joining,
No,
and
thanks for having
sorry
me
for the
on. Thanks
technical thing,
for.
and we could not see your pretty face. So maybe next time we'll have a better technically sound
Yeah.
meeting.
Well, thanks for having me on. Thanks for everybody who joined and listened in. And yeah, we'll do it again soon, Andrew.
Yep. All right, bud. I'll
All right,
talk to
buddy.
you.
Talk to you, man.
Bye.